Light bulb, did you know that in 2025, more than 65% of global loan approvals will be decided not by a human banker, but by an artificial intelligence algorithm? That's right. A machine is quietly judging whether you get that car loan, home mortgage, or even a credit card. Now here's the shocking part. Some banks are already using AI models trained on billions of data points, not just your salary or your bill-paying history, but even your phone usage patterns, shopping habits, and social media clues. So here's the big question. Is your bank still stuck in the old-school credit score era? And could that be costing you real money? Stay with me for the next 30 minutes. We're unpacking exactly how AI is rewriting the rules of credit scoring, what it means for your finances, and how you can stay ahead of the curve. Welcome back to the channel. If you're new here, I'm your name, and every week we break down the biggest shifts in global finance and technology. Today's topic? AI and credit scoring, something that affects anyone who's ever applied for a loan, from a small business owner in Karachi to a first-time homebuyer in London. Let me start with a quick story. Last year, a friend of mine with a flawless traditional credit score applied for a small business line of credit. The bank's new AI system instantly approved him, but offered a lower interest rate than anyone expected. Why? The AI spotted patterns, like his steady e-commerce revenue and low late-night transaction spikes, that a traditional credit bureau would never even measure. By the end of this video, you'll clearly understand how AI models work in modern credit scoring, why traditional credit bureaus like Equifax or Experian might soon look like relics, and what steps you can take to protect, and even improve, your own financial future. To see why this matters, let's rewind. Traditional credit scoring, like the FICO score introduced in 1989, relies on a handful of data points: payment history, amounts owed, length of credit history, new credit, and types of credit. For decades this worked, sort of, but it left out huge groups of people. For example, nearly 1.4 billion adults worldwide are credit invisible, according to the World Bank. Meanwhile, global lending is massive. The consumer credit market exceeded $11 trillion in 2024. Banks and fintechs want more borrowers, but they also want lower risk. Enter artificial intelligence. Around 2017, fintech pioneers like Upstart in the US and Ant Group in China began training machine learning models on thousands of variables: utility payments, mobile phone top-ups, even how quickly you scroll through online forms. Results? Upstart claims its AI model approved 27% more applicants while maintaining the same default rate. Alright, let's open the black box. AI credit scoring is built on machine learning algorithms. Think of them as super smart pattern detectors. Instead of a human deciding which data matters, the algorithm finds relationships in hundreds of thousands of data points. Case study: Upstart, USA. Upstart uses non-traditional variables such as college major, job history, and even how you interact with their website. They feed this into a neural network that predicts default risk. Simple comparison: traditional FICO is like judging someone's health only by weight and height. AI scoring is like a full-body MRI plus blood tests and lifestyle analysis, much more detailed. The benefit? Financial inclusion. Millions of people with thin or no credit files, think students, gig workers, immigrants, can now access loans. You might be asking, okay, but what's in it for me? First advantage: better rates. AI lets banks price risk more precisely. If the model sees you're less risky than your FICO score suggests, you might get a lower interest rate. Second, speed. AI systems can approve loans in seconds, not days. Imagine applying for a small business loan on a Sunday night and getting approval before Monday morning. Billions of people who never had a formal credit history can now prove reliability through digital footprints, like regular mobile payments or e-commerce activity. Consider billionaire Jack Ma's Ant Group. Their AI-driven credit platform Huobi and Jebe served over 500 million users in China by using alternative data, the dark side, risks, and bias host. Every technology has a shadow. Risk 1. Bias and discrimination algorithms are trained on existing data. If historical data reflects social biases, the AI can amplify them. Example: in 2019, Apple's credit card algorithm faced criticism after women received lower credit limits than men with similar profiles. Risk 2. Privacy AI models often pull from vast datasets. Mobile phone usage, social media, even geolocation. That's sensitive information. Risk 3. Lack of transparency. Unlike a FICO score, where you know the 5 factors, AI models are often black boxes. Good luck appealing a decision. Analogy: imagine you're playing a board game, but the rules keep changing, and only the computer knows the rules. That's how an AI-based credit decision can feel. Looking ahead to 2025 and 2030, here's what experts predict. Global expansion. AI credit scoring will dominate not just in the US or China, but across Africa, South Asia, and the Middle East. Regulation. Expect new laws demanding transparency, like the EU's AI Act, forcing companies to explain algorithmic decisions. Integration with CBDCs. Central bank digital currencies may directly feed transaction data into AI models, making credit scoring even more dynamic. What if scenario? Imagine a future where your real-time financial behavior, every mobile payment, every utility bill, is continuously updating your credit score in the background. A late electricity payment today could instantly nudge your interest rate up tomorrow. Opportunities? Better financial inclusion. Millions lifted into the formal economy. Smarter risk pricing, possibly lower borrowing costs. So, let's recap. AI is transforming credit scoring from a handful of numbers to a dynamic, data-rich system. It promises faster approvals, lower rates for responsible borrowers, and wider access to credit. But it also raises serious concerns: bias, privacy, and transparency. Here's the memorable takeaway. In the future of finance, your credit score won't be a number you check once a year. It'll be a living algorithm following you every day. If you found this breakdown valuable, thumbs up like this video, bell subscribe for more deep dives into AI and global finance, and speech balloon comment below. Do you trust an AI algorithm to judge your creditworthiness? Or would you rather stick with the old school credit score?